So, welcome again to my accounting tutorial channel where I convert technical lessons to a storytelling version, sort of. Now, let me remind you again that we are now on the accounting for loans receivable topic. And in the last episode, we already made a sample problem, which is this one. And we already have the initial entry as well as the initial valuation of the loans receivable account. But before we go any further, I would like to correct this amount. So this amount should have been 4,769,779 instead of 4,769,774. So that's an honest mistake. So again, for those who noticed and for those who told me, and thank you. Thank you for correcting me. So again, going back, the initial balance came from the principal amount minus the origination cost received from the borrower, plus of course the direct origination cost incurred. So that's only one way of getting the initial balance, to be honest. Because actually guys, you can also get the initial balance by discounting this principal and the interest to be paid by the debtor in the future. So even if these origination costs, these two, are not given, as long as the effective rate is provided, then you'll be able to get the initial balance. Okay? But in this sample problem, the effective rate is not given. However, we can already get the present value or initial value because again, the problem has these two amounts for origination cost. So making an initial entry with the amounts is now not a problem. Okay? So the problem occurs after the initial entry. The problem is we can't go and complete the timeline for 4 years because again, we don't have an effective rate. And I told you to find it by doing a trial and error and interpolation in the past episode. So, the correct effective rate is 11.5%. So, I will not do an interpolation already because I already know from the very beginning that the effective rate is 11.5%. So, did you get it? If you did, then good job. So, what I'll do is just check if ever this 11.5% is actually correct by using this rate in these formulas. Okay? So to do that, let's go to a new slide. So again, let's have the proof that 11.5% is really the rate. So 5 million times 1.115 raised to the power of negative 4, or this factor, that's equals 3,234,972. So that's for the present value of the principal. And as to interest, we have 500,000 times 1 minus 1.115 raised to the power of negative 4 divided by 0.115, or this present value right here, equals 1,534,806. So that's the present value of the interest. Now, the sum of these two is actually 4,769,778, which is almost the same with this one. So they only have a very slight difference of 1. So it's fine. Therefore, because of this, we can conclude that 11.5% is actually the effective rate that we are looking for. Now, since we already have the initial value and the effective interest rate, it's now time to get the loan receivable balances on the subsequent dates, and of course, it's already time to make journal entries in the subsequent dates also. Now, let's make a timeline for 4 years. Okay? And then, again, the beginning balance is 4,769,779. So, since the effective rate is already 11.5%, then we can multiply this immediately by 1.115 or 111.5%. And we will get a balance of 5,318,304 minus the first interest payment of the debtor of 500,000, and we will have 4,818,304 times another 1.115, and we have 5,372,409, and minus 500,000 again, and we have 4,872,409 as the balance at the end of year 2. So moving on, we have to multiply this again by 1.115, and we will get 5,432,736 minus again 500,000, and we will have 4,932,736 times 1.115 again for the last time, and we will have 5,500,000. And actually, it's not exactly 5.5 million. There is a difference, a decimal point. But anyways, the difference is very immaterial. So let's stick to 5.5 million and then minus the final 500,000, and we will get the principal 5 million. And then because it's the end of the maturity term, then 5 million minus 5 million equals 0. So that's the completed timeline. Now, it's time to make the journal entries. So, let's have the journal entries. So, the initial entry, if you remembered, is debit loans receivable and then credit cash for 4,069,779. So, now, it's time to make an entry for the subsequent dates. So, at the end of year 1, of course, you need to debit cash 500,000 because that's the interest payment of the debtor and you're going to receive it. Okay? And then, you have to debit another account, the loans receivable, because as you can observe, the balances of the receivable increases each year. So again, you have to debit loans receivable account. Okay? So the amount is the difference of these two carrying amounts, and you will get 48,525. Now, what's the credit? The credit is the interest income, which you can get from the difference of these two. Or, you can make it the balancing figure in the journal entry. Either way, the amount that you will get is still 548,525. Now, one of the nice things when making journal entries for long-term receivables or payables is that if you have already made an entry for the first year, the subsequent entries will be very similar. Of course, except for the amounts. Meaning, in the second year, the third year, and fourth year of this sample problem, the debited accounts are still cash and loans receivable accounts. Of course, the credit will still be interest income. And since the interest to be received are the same, then debit cash for all the years is also the same, which is 500,000. Now, for the debit loans receivable for the year 2, you just have to compare these two and get the difference. So that's 54,105. And for the third year, that's 4,032,736 minus 4,872,409. So that's 60,327. And lastly, for the year 4, we have 5 million minus 4,932,736, and that's 67,264. So, as for the interest income, again, you can make it a balancing figure in the journal entry, or you can get the difference between this after interest amounts with the before interest amounts. Like in this year 2, that's 5,372,409 minus 4,818,304, and you will get 554,105. So those are your two options. So for me, and for this video, and for the other years in the sample problem, let's make the interest income the balancing figure in the journal entries So that we'll be able to save time. Okay? So here we have 560,327, and here we have 567,264. Okay? So one last entry. So we have the entry for the principal collection because again, it's already the end of the maturity term. So we have to debit cash 5 million and then credit loans receivable account for 5 million also. So that's the subsequent measurement and the journal entries. So we are assuming that the debtor is going to pay religiously his obligations. So that's it. Now, I call this overall set as direct to the point measurement and entries. So, why? Because there are a lot of methods present and the other accountants don't measure and record like this, although the substance is the same. Like for example, instead of this timeline, the others are using the amortization table. Okay? And some has a different way of making journal entries. But then again, let me repeat, the substance is still the same. So let's go and compare those methods with this in the next episode. So thank you for watching, and remember, even though there are no shortcuts in learning some accounting topics, there is always an easy way to understand, and you need to find that. So again, thank you, and I'll catch you on the next one.